I have prepared 9 trend trading strategies that will also help you understand how strong is the trend and how far will price go. So hello, welcome back, and thank you again for this crazy feedback. My channel is currently really blowing up, so keep the comments coming. Every comment, every thumbs up really makes a big difference, and I will keep making videos regularly, every Wednesday, every Sunday, if you keep supporting the channel. So leave a comment right now, leave a thumbs up, subscribe, and now let's get into the video. So within this video, I will explain 3 different trend strength strategies or tools. So the first one is going to be the ADX. In the second one, we're going to use overbought and oversold from the stochastics. And in the third one, we're going to use Bollinger Band trading strategies. We have the second one, which is Bollinger Band trading, and we're going to look at 3 different Bollinger Band trading strategies. The first one is riding the Bollinger Bands, the second one is a squeeze, and then we're going to look at break the Bollinger Band width. So we are going to first look at Bollinger Band riding, and Bollinger Bands, it's this channel here you can see in black, above and below the current price. I set it to 2.5 standard deviations, which is a little bit higher than the regular 2.0. And after the market was in this range here, the ADX obviously will also be below 25 because the market is just moving sideways. First, the market broke out of this range, and then it started this new uptrend. And during a trending phase, especially during strong trending phases, the market will usually move between the outer Bollinger Band and the middle band. And you can see that very clear at no point until here, when the trend was seemingly over and when the market didn't move higher as easily anymore. That's the only time, and it's the first time when the market broke the middle band. But before that, the market was moving up very nicely. And this is what you call Bollinger Band riding. So whenever the Bollinger or the price is between the outer Bollinger Band and the moving average, then you are in a clear and strong market and a strong trend. We can see the same here. You can see the market here dipped into the outer Bollinger Bands after the squeeze. So this is actually the squeeze pattern, and the squeeze consists of 2 parts. The first part is a very narrow Bollinger Band. You can see that here, a very tight Bollinger Band, which means that the market was also trading with very small candles, not a lot of momentum, not a lot of volatility. And then once you see that the Bollinger Bands are widening, which happened here, then you're often at the origin of a new trend. So Bollinger Band squeeze and then the Bollinger Band breakout, you can see that very clearly here. The Bollinger Band then started to widen, and it also happened with a strong bearish momentum candle. That is then when this new downtrend started. Obviously, it wasn't a very long one, but you can see clearly that the market was trending lower afterwards. And then here you have a second chance. You can see the Bollinger Bands are narrowing again. You can see very tight. And then suddenly the Bollinger Bands widened again. You can see that here. And then the market and the price was trading into the outer Bollinger Band. So you can see you have a squeeze. You have then the widening of the Bollinger Bands, and then you have the third component, which is the Bollinger Band riding. And as long as the market is able to stay so close to the Bollinger Bands, usually there's no threat of the market turning around on you very quickly. You will see that afterwards the market pulled away from the outer Bollinger Bands, and then the most important part of this trend was over. So you can see how you can put this very nicely into context together. The third one is Bollinger Band width, which is a really interesting approach. It also uses, it's also based on a little bit on the squeeze. So whenever the Bollinger Bands are very close together, you would wait for the breakout. So here we have the Bollinger Band width, and also we have a moving average here on the charts, on the Bollinger Bands. And what you want is, so the Bollinger Band width is actually the orange or the red line or the pink line, whatever color you classify that. And what you want is to have the Bollinger Band width trade above the moving average. So you can see here the market and the Bollinger Band width separated itself and traded above the moving average. So here you can see, in here you probably have a very tight Bollinger Band, and then here suddenly the market broke out and started this rally. So you can see then the Bollinger Band width increased again. And this is very typical when we look at the previous chart. You can see during trending phases, the Bollinger Bands get very, very wide. That's really important. You can see that during ranges, very tight Bollinger Band, and then during a trend, the Bollinger Bands get really, really wide. So, and then here, when the market is slowing down, the Bollinger Bands get very slow and very tight again. So that's a really important characteristic of the Bollinger Bands. And you can see whenever the Bollinger Bands get wide, like here, then the trend is accelerating. Here's, again, the trend is accelerating, and the Bollinger Bands are getting really, really wide. So really important as well. And especially when you can see that the Bollinger Band width is pulling away from this moving average that significantly, then you're often looking at a strong trend. And then when the Bollinger Bands are getting closer again, like they did here, then the trend is very likely to be over. So this is how you can use Bollinger Band width, how small and how narrow are the Bollinger Bands, to find trends and to find breakout opportunities as well. It's a really powerful tool. The third one is overbought and oversold, and I'm going to use the stochastic for this example. We're going to use overbought, oversold riding, higher time frame overbought, and also trend following. And it's really, really important that you get away from the idea of thinking that overbought means that the market is going to reverse lower. And also don't believe that just because the market is oversold, it means that it is likely to reverse higher. Overbought and oversold are not reversal signals. Exactly the opposite is true. When you see overbought, it means that there's a strong trend. When you see that the market is oversold and the stochastic is oversold, it means that you are trading with a very, very strong downtrend. That's really important. Don't go against your overbought and oversold. And I have a few examples. So here, the stochastics went into oversold here. And this was just the beginning of this new downtrend. And the price and the stochastic stayed in oversold for many, many days, more than a week. And this is something that will happen over and over again. And traders who go against their stochastic will often lose a lot of money. So instead of going against the oversold, go with it. Maybe apply a moving average to it and then ride the oversold and overbought. Here, another example. This is a trade that I was in. I got in around here when the market had a breakout, and afterwards the market turned around and is currently trading around here. I had my take profit, I exited the trade, and also overbought gave me confidence in the trade because I knew that overbought means you're looking at a very, very strong market. This is just the way the stochastic is calculated. When you look at the formula of the stochastic, you can see right away within a few seconds that if you have overbought, it just means that the market is in a super, super strong trend. It's a really bad myth that has been around in Forex or in trading in general for many, many years, that people go against their overbought and oversold. Go with them, use them the way they are intended to be used, and you will make much, much better trading decisions. Here again, strong overbought, strong uptrend. Oversold, strong downtrend. Overbought, strong uptrend. This is such a common behavior in the markets, and you should not go against your stochastics. Another option that you could also use here is that as soon as the stochastic go into overbought, this is the 4 hour, you could go down to the lower time frame, to the 2 hour or to the 1 hour, and then trade into this direction of the higher time frames. Stochastic especially. This is something that I've seen many, many traders do. You go to the higher time frame, you wait until the market is overbought and oversold, and then you go to the lower time frame and trade into that direction. And you could also use a moving average. So I applied a 70 period moving average to this chart to have a long-term trending filter. And when the market and when the price is below this moving average, you would only look for oversold opportunities to go into trend following trades. And you can see whenever the market is in oversold and below the price and below the moving average, then you have a good bearish push. You could use them to time trend following entries. Obviously, the later you enter in a trend, the harder it becomes to profit. So you really want to focus on the first and the second opportunity. And you can see, even though the market is overbought, during a downtrend, it usually doesn't work as nicely. So try to really find only trades into the direction of the overbought and oversold, and you will make much, much better trading decisions. So let's start with the ADX. And what we are going to use is the ADX line, not the DI plus, not the DI minus, because everything that we need is in the ADX line. We're going to use the threshold of 24 or 30. We're going to look for breakouts, and we're also going to look for other factors. So here at the bottom, you will see the ADX. This is just the ADX line, not the DI plus, not the DI minus. That's more than enough to understand the strength of the trend. And you can see I established here the 25 level. Some people use a 30 line, some people use even higher, some people use a 20. I prefer the 25 line. And what this means is that when the ADX is crossing above the 25 line, then the market is entering a trending phase. If the ADX is below the 25 line, then the market is in a sideways range. So this is how you're going to use the ADX in a very, very simple way to differentiate between trending phases and ranging phases. Also, another thing that could be helpful is to look for the slope of the ADX. You always want to look for an ADX that goes up and not like here that is going down. Even though it's above 25, if the ADX is going down, you don't have a trend. So only if the ADX is going up and only if it's above 25, then you're really looking at a strong trend. And you can see I marked here the crosses here and here that signal the ADX trend. Here obviously would have been another one. And here I have marked the cross when the ADX started going up again. So here the ADX was going down and then it went up again. So this is usually how you use the ADX. And you can see in the first scenario, the cross marked the origin of a new uptrend. Here, when the ADX started going up again, it marked the origin of a new downtrending phase. Here, the ADX was below 25 and the market after this period here just went sideways. And then here, once the ADX crossed above the 25 line, the trend accelerated once again. And especially here, after the second crossing, which happened here, the trend really accelerated to the downside. So having the ADX as a tiebreaker between trending and ranging phases can help you already a lot. And the higher the ADX, and the stronger it is rising, the stronger the trend is. And you can see when it's very, very strong and when it's rising a lot, then resistance tends to break, support and resistance don't hold, and you will often experience successful breakouts and not failed breakouts. Here you can use the ADX together with a breakout pattern. So I drew this channel around the price, and at the same time, when the market was in a sideways period, the ADX was also mostly below 25. And then once the ADX broke above the 25 line and also broke out of the pattern, then the new uptrend was started. So you can combine the ADX very nicely with breakout scenarios as well. Here we have another very, very interesting study. I also added a long-term moving average to the chart. And you can see here the ADX was trading well below 25 when the market was ranging sideways. So when the ADX is sideways, it means that the price is in a range, and we can clearly see that. We have very well-defined support area here. And then once the price broke the support area, this was also the time when the ADX was going above 25. So really nice how this fits together. A breakout out of the area with the ADX going above 25, and this then initiated this long-term downtrend. And you can use the ADX together with moving average, you can use it with breakouts and with general trend following very, very effectively. So I hope you enjoyed this video. If you did, leave a thumbs up. Let me know if you've learned something new, maybe something that you didn't know before. Also let me know what other videos you would like me to make, and I will do that in the future.